Hello, I am Sensei Kevlar. Thank you so much for coming, guys. I really appreciate it. I really would like the opportunity to sit down and talk to you about the way that I have made my money and the way that I have made my opportunities in these markets. And it's going to take a little while because it's a really in-depth and deep subject, and there's a lot to it. And so I need to start out by just asking something of you right off the bat, and that is your commitment to time and patience, because this is going to take a little bit. It's one of those things that you have to take away the lessons and go and practice them. You have to execute on building plans and doing all of the things that I show you how to do in order to take value out of it. And it's that value that I think that you will see right away and continue to grow if you stick with it. But in order to make sure that we stick with it, there's something that I really have to ask you to do. And that something is stop trading. I really need you to stop trading. And the reason that I say that is because there's a lot of people out there that do things to make money by trying to teach you how to trade, and it's a scam. And I want to start by just kind of walking through that really quick. This is not a situation where I'm going to tell you the following: you should buy here and then sell here, and this is how you'll make money. You'll make money by following me and doing what I do. That's a really common scam, and I don't believe in it, and I don't believe you should invest in it. And the reason being is because these things, they don't always work. What you're doing is you're relying on somebody else to do your planning and your trading for you. And this isn't a reliable way to trade. Another thing that people do is they sell you what they call strategies. And I'll be talking a lot about strategies, but I'm not going to be talking about them in the same way that they do. What they'll do is they'll say, if you just run this software, if you just follow this indicator, if you just do this thing, if you just, buy when the market comes down, if you just follow this, whatever it is, if you just follow this method, you'll make money. And I'm telling you now that that's a scam too. And we're not going to do that. What we're going to do is we're going to look at how opportunity generation actually works, and we're going to figure out methods for staying in the market long term. And those methods are really not about timing the market. That's what all of these other ones have in common, is they're trying to time the market. And when you think about the reality of crypto, that simply doesn't work. If I knew a time when the market was going to go up or the market was going to go down for certain, I would just do that instead. That would be the obvious thing to do. And instead, what we're going to do is we're going to sit down and figure out how to actually make this work for us. And what I ask is, I ask that you are respectful of the people in the dojo. I ask that you are respectful of the people who might watch after this, and realize that we're all of certain learning levels. Many of us are coming to this having already done a lot of trading. We've already looked at a lot of charts. We understand what TA is. We understand what all the things we're going to talk about are. And I'm asking you to kind of leave that behind. I'm asking you to stop trading. And if you take what it is that I'm teaching you and you go to the market and you start trading with it, I can't help you. That's not what I told you to do. I asked you to stop trading so that we might learn a better way together as a group and figure out if it really does work without losing money, without actually putting our money in. That's a really important part of this. I want to make sure that we're all clear on it. If you are trading what it is I'm talking about, you're doing it wrong. What we're going to do is we're going to figure out how to make it work on paper. We're going to figure out if we could actually have made money, and we're going to make that result unambiguous. We're going to make it scientific. We're going to make it completely real, measurable in every way. And we're going to figure out if that's really a worthwhile endeavor for any one of us to take, and for any one of us, that might be a decision that we individually take independent of ourselves. This is not trading advice. This is not financial advice. I am not a financial advisor. I simply am showing you a method that you might use in order to help yourself. And in exchange, I really do ask that you try and learn the paper trading method, because that really is the way of the trader, to understand his profitability without actually executing a trade. So again, I apologize if any of this comes off as a review, but we're going to go back to basics. We're going to really follow the path all the way from fundamentals on through to the really depthful things, the really cool aspects of trading. And along the way, we're going to learn a couple new methods, I hope, for some of you. I mean, if you already knew this stuff, I imagine you wouldn't need to learn how to trade. So let's begin. What I'm going to do is I'm going to pull up a browser, and I'm going to go to a trading site, or a charting site. My favorite one happens to be TradingView. Doesn't have to be. I'm certainly not encouraging you to go to any one site or spend money on any one thing. What I'm going to do is I'm going to pull up a chart. ETHUSD happens to be a good one. And what I'm going to do is I'm going to look at it and just talk about briefly what it is I'm looking at. If my internet would like to work, that would be great. Alright, let me get rid of some of these. Sorry, I did not mean to have all this information come up on the screen. Usually when you pull up a chart, you'll just have some really basic information. It'll look like the following. What we're looking at is candles. When I scroll my mouse wheel, I can zoom in on the candles. And the way that the candles work is these are aggregations of a time frame. You can choose the time frame right here. Say I want a day. And what this does is this aggregates the price within a given day. Here's the 14th of November. And when we see a red candle, what that means is that it closed higher than it opened. So the price started out right here at the top of the bar, and it closed right here because this is a red candle. It also moved within these extremes intraday. So at some point in the day, after it opened right here, it went as high as here, see that wick right there, and it came down to here, see that wick right there, before coming back up to here at the end of the day. One day. This is another day, this is another day. Let's take a look at a green candle. On a green candle, the roles are reversed. It opened down here, it came down to this wick right here, it came up as high as this wick right here, before at the end of the day, it closed right here. Now, what we can say about this is that these things go up and down. That's about it, for sure. And what I'm going to teach you is that anyone who says that they know what direction this chart is going to go is a fool. I just disagree with anything that they have to say on the subject right off the bat. What I want you to learn is how to study these charts and how to make money off of them, even when you don't know what direction the price is going in. So how could that possibly work? Well, it works by making the assumption that eventually they will go back up, even if a small amount. And it turns out that that assumption is pretty much true on any given time frame. Let's take a look at the time frame here of when it went down all the way down to here. The fact of the matter is it did go up. It went all the way down to here and gave us a really nice buying opportunity if we had known to buy right here, only to come up again. The problem is that this is what could also happen. And this is a losing proposition, pure and simple. So what we need is a strategy that has us making money when the market comes down on us, and making our money when the market goes up on us. Both need to be true. And if we are interested in a given opportunity, what we need to do is we need to find out the best way to make that happen. This is effectively an optimization problem, if you know how to make it work. But there's a fundamental idea that I'm going to introduce right now, just right off the bat, because this underlies everything else that we do, and that's dollar cost averaging. The idea behind dollar cost averaging is when you purchase something, say it's up here at the 800 mark, it then comes down to the 520 mark. Okay. At this point, if you had actually bought right here, you would be down some money at this point. But you would still be holding a position that's worth something, right? Specifically, what you would be looking for it to do is you'd be looking for it to make a return to this line right here, and then go above in order to make you some more money. But then it doesn't do that. And so as a trader, we're sad. And this didn't work out at all. So what can we do a little bit differently in order to make this work for us? Well, one thing we can do is when this goes down, if we had, $100 right here, and then we bought another $100 right here, what that would do is that would half the cost of our position. Okay? The reason for that is one position at $800 plus one position at $550, let's call it, nice round numbers there, is equal to about 675, right? That's the math on that. So we can plot this rather easily. We can simply say, pull up our calculator. Right? We can say 800 plus 550 divided by the number of positions that we have, which is 2, $675. Okay? This is how much each position is worth on average. So, what that means is if we held one position here, we're holding 2 positions here. What needs to happen is the market needs to come back up and make us that money right here. And it doesn't, so we're a sad trader. Okay? Well, what about what happens when the market comes down and we buy 3 positions? Okay? Let's take a look. Clear out the calculator. Say 800 plus 550 plus 550 divided by 3. I think I screwed that up. Let me do that again. Yeah. 800 plus 550 plus 550 equals, divided by 3 is $616. Well, look at how our position has come down. There's $616. And look at this. We came right up and touched the profit line. Still doesn't actually make us a happy trader because we didn't make anything. Let's do it one more time. Instead of buying 1 position here and 3 positions here, what we're going to do is we're going to buy 1 position here and 4 positions here. 800 plus 550 plus 550 plus 550 divided by 4 is 587. Take a look at what happened. There's 587 right there. What happened is that suddenly we're in the profit. Suddenly what happened is we turned a losing proposition into a winning one. How much profit? Well, let's take a measurement. Let's get the right. There we go. It's about 6%. Right? Yeah, about 6% if you sold that candle, sold the top of that candle right there. Right? Well, 6% on your money on a losing bear market, I'd say that's pretty good. Well, what happens if we do the same thing over here? We make the money on this leg of the motion right here. What's this right here? I mean, that's 30% right there. That's some nice motion right there, right? What we can say about this with some reliability is that, with any reliability, is that in order to make the money on the motions like this, we must be in the market. In order to make the money on the motions like this, we must be in the market. In order to repair the motions like this, we must have money to put more into the market. That's true because in order to make the money in this market, you had to be bold about your buying. So, if the opportunities lie in making the money as the market goes down, and it is required that you have more money, then you must allocate very, very small and appropriately at the top here, and figure out how it is you're going to be doing your buying as it comes all the way down, such that when you get to where the bottom is, and where is the bottom? I'll tell you, it's this guy right here. The big zero, that's the bottom of the market. That's where markets can go. It's called delisting. But if we assume on any stretch of time that the market will go up again, then we can create a strategy which has us buying the market when it goes down and selling it whenever it makes us a profit. The trick is to make sure that, number one, you're optimizing how much it is you're buying in terms of making that money in order to make sure that you're getting above the profit line when the market does move back up, and that you have enough money to be doing all of the buying all the way down the market. This is the essence of planning. The idea behind planning is that if we know ahead of time where these situations are going to occur that we're going to want to be doing buying in order to take advantage of this, if we know these places, then we can create a strategy which has us only buying at the places where the market is going to turn around. And if we buy enough, then we can profit off of those opportunities, even in a down market. Now, in an up market, this is easy. In an up market, this is quite obvious. Nobody needs to tell you how to make money in an up market. You buy, and then when it goes up, you sell. So if you buy, and then it goes up, and then you sell, you make money. But if you buy, and then it goes down, and you buy, and you do it at the right places, and you do it with the right amounts, then you make money. And if you miss your opportunity, you need more money down here. And you need to buy the right amounts down here to make your money up here and up here. And if you miss that, then you need to have the money to be buying down here and down here. And if this is how you're going to allocate your portfolio, then allocate your portfolio in this way. And what we do is we learn how to allocate our portfolios in such a way that we can do this all day long. And what's more is we can do it very effectively. We can make sure that we're doing it with a statistical probability of where the market will turn around. And that statistical probability is where we shift the odds into our favor. Knowing that it could not give us this profit. Knowing that if it never goes back up, we're still going to be doing the buying down here and watch it go up here. Knowing that if it never does that, if it simply goes down here, we're going to be doing the buying and taking our profit here. And if it doesn't do that, knowing that we're going to be doing the buying down here. This is why small allocations at the very start are really critical. Because if you really do have a plan, and the plan really does have you buying to the bottom of the market, and this is the bottom of the market, right here, delisting. And then this market really does get delisted, well, guess what? You lose your money. Again, this is about shifting the odds into your favor. The odds of a top 10 coin going to zero and becoming delisted are low. The odds of a shit coin doing it are better. But with statistical probabilities that we can measure, we can allocate our money in such a way that we can statistically prove that this allocation strategy will make us money on these motions. And that's what we're going to learn. That's what I'm going to show you through a series of technical analysis. And what technical analysis is about, looking at these things, looking at these candles, and finding the statistical probabilities by which they occur. Which is to say that if this happens with a 78% chance, then I'll bet on that. Realizing that we're betting on a 78% chance. It's like on dice, right? A good 22% of that you're going to lose. It's just going to do one of these. And you better be prepared. So the true strategy, the actual way that a master trader will trade, is he will never take a losing trade. There's no need. There's never a point at which a trade becomes losing until it becomes delisted. Because he always has more, and we can plan more buying opportunities, and then when the market does turn around, that's when we make our money and prove that this was not a losing opportunity. Now, of course, on some of these, you're not going to get that opportunity. On some of these, you're just going to do one of these for a while, and you're never going to go back up where you think you're going to go for a long time, like this. Look at this. Look at this sideways motion where you're making no money on this market. This is about diversification, and diversification is something we'll be spending a lot of time on. Because while this market is doing one of these, there are other markets that are doing the opposite. And there's no way that anyone could possibly, with any reliability, predict this beyond some percentile. It's like a 50-50 coin toss, and if we know the odds are 50-50, then it coming up heads 5 times in a row, well, that's not unexpected. It going down over and over when your technical analysis says it's going to go up, well, that's not unexpected. And you better have a plan in place. So the plan is to make sure that we can find these levels. Well, as it turns out, these levels are highly correlated. In fact, if you just come over here and you take your drawing tool and you say, I'd like a horizontal line, please. You click on the drawing tool right there. I'd say, I'd like a horizontal line, please. And all you do is you come over and you click the tops. Okay. Well, look at what happened. Is it came up and it found resistance at this level.
And then it came down and it came up and it stopped at exactly the same level. It found resistance going up, and then when it came down, it found support. So let's draw that line too, the support lines. Anytime we see the thing come flying up or come flying down, we'll draw the resistance and support lines. Well, it certainly did here. In fact, look at what happened. It came up, came back down, bounced off of here. And look at what happened when it came flying back down. Okay, so let's say that we're here in time. Let's say that this is the price today, and this is the chart that we're looking at. We know from past experience that when the market came flying up, this was a resistance point, and this was a support point. This was a resistance point. Where might we expect to find a support point? Would it be at the previous support points? I'd say yes. Would I be right? I'd say yes. With what degree of accuracy? Well, at this point, the degree is 100%, and clearly we only have a correlation number of 1. It's not exactly a very good amount of data, right? So now we're going to look for other times when it came busting through in order to break our correlation. Or alternatively, it respected that support line. Sure enough, here we are today at exactly the same level. The market came crashing down, and it came crashing right into that support line. Now, what's interesting is I think that you'll find is that these levels are correlated for a reason. What's happening is other traders are doing exactly what I'm doing. They're looking at the charts, and they're seeing that these these support levels right here and right here are correlated to the support levels right here. So when the market goes into free fall, where do you think they set their bots to do their buying action? Let's assume that most of this market is driven by bot action. If you were a bot designer and you were looking at this chart, where would you set your bot to do its buying action? Well, I'd obviously be considering this. I'd be considering this with a high degree of statistical correlation. I'd be saying that 100% of the times that this has come down and gotten to this level, it turned back around. Because guess what? It's true. Now, does that mean that this will occur 100% of the time? No, it doesn't. Not at all. But we can say that in the past it has. And this is relevant, and that bot owners are going to be looking at this and doing some calculations on this. Can we expect a correction, probably up into this level right here? Well, let's figure out where it might come up to. Where do markets come up to? Where do they fly up to? Well, previously they've flown up to their resistance points. Right here it came up and made a new resistance point that it's never made before. Later, that point was respected. Later, we saw it break through, and here's the anti-correlation we've been looking for. Where it came up and touched the resistance point, and then blew right through it. Was this predicted? Absolutely it was. There's no way you could possibly say that the prediction was 100%. We could simply say that the correlation was 100%. And here's our anti-correlation. So 2 out of 3 times, this has been respected. But then what happened is it came flying back down. And when something comes down and then turns the market around again, that becomes support. And then it did it again. Twice. This previous resistance level right here and right here, when the market was going in the opposite direction, became support. This is a correlation. I would say that this level right here is pretty highly correlated. It's correlated both by resistance and support. That gives us statistical correlations that are meaningful. And later on, when the market came flying down and tested that, I mean, I wasn't even looking at that. I was simply saying that these were meaningful, relevant statistical correlations. Later on, do you think the bot owners agreed? Well, I would certainly say that they did. I would say that that is a money-making opportunity. Here, we have statistical correlations that pointed at a strong money-making opportunity. If we had been doing our buying. If we had been fearlessly buying the market. Okay? Now, the trick is to make sure that when this is happening, we're not buying. We want to optimize this out. But we want to make sure that we're paying heavy attention to this, and this when we come flying back down here. See, the same thing happened here. Here, this support line became this support line. Okay? Here, when the market was coming back up, well, we certainly did pause and go a little bit sideways at what previously had been the support line. Now we became the resistance line. Looks like we might think about turning back around before bouncing off of the support line and going back up. And there's our money-making opportunity again. If we can find the statistical correlations that point us towards optimizing our buying strategy, that has us removing these because they're simply not at correlated resistance or support levels, that would greatly increase our chances of buying something like only this level followed by this level, even when our initial position was up here. Okay, so let's try that out. Let's say that we actually did do our initial buy, thinking, oh, the market's finally going to turn around. Okay, I'm going to put our initial buy right there. Then it comes flying down and we hit our first historical, let me get rid of that, historical support level, right? Right here it was resistance, right here it broke through it, right here it became support. Okay. Let's say that we want to buy this, we have a plan to buy this, followed by this, followed by this. We're going to allocate. We're going to say, well, I've definitely got enough money to triple up, quadruple up, 5 up right here. Definitely got enough money to triple up, quadruple up, 5 up right here. Definitely got enough money to triple up, quadruple up, 5 up here. How do we know that? Because we already did the math starting down here. Starting down here. One more buy down here. We already did the math, figuring out triple up, quadruple up, 5x up. We did the math starting right here, saying if we want to go 5x, 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 and then we're going to have this much money allocated, then we can work backwards through the math. How much money do we need to start with? Times 5, times 5, times 5, times 5. That's our final allocation. Do we have a plan in place? Can we show that this opportunity made us money? Right? Can we show that based upon our analysis, if we're doing our buying right here today, it's today. This is all the more we know. We don't know the future. We think it's going to go up again. We're buying. We think it's going to go up again, and we're buying. And then the market comes down. Well, did we have a plan in place for this? Did we buy this line right here? Did we 5x up our position? Okay. Did we, let's say we double up. Let's say we, just split that in half right there. Let's change the color on that. Okay. Let's say we double up. Do we make money? No, we don't make money. Okay. Triple up, quadruple up, right? Say we 5x up, we're still not making money. I mean, it's coming up here and it's giving us nothing. We're not even hitting our profit targets, right? then the market just goes away from us again. I mean, we're not making any money until we do, until we get to here, and then we buy, and the market goes up again. Well, equally, where are we going to be doing our selling? Do we have lines from the past that can tell us where we're going to optimize our selling at, where it's most likely to start going sideways at after a big run? Can we optimize for that parameter, knowing that our plan will keep us in the market forever, knowing that our plan will make us profitable no matter what? No matter what happens, no matter if the market comes down and down and down, the plan will make us profitable. Plan will always keep us profitable. Plan will always keep us having more money to allocate as the market goes down and down and down and down and down. And oh my God, everything's red and panic. Everybody's talking in the chat. Sell, sell, sell. Everybody hates crypto. Crypto's dead. It's over. Sell, sell, sell. Okay? No, that's not reality. It's not about timing the market. It's about time in the market. It's not a reality. Okay? You see this is what panic looks like. Okay? This is not what panic looks like. I'm sorry. This is what a market bottom looks like. This is just, just absolutely trying to get the last gasp out before the big bull run in March and July of 2019. This is not panic. This is panic. This is what you need to have a plan for. This is what planning is about, and this is where planning will make you profitable. Because all of these other strategies that these people are going to sell you, that they're going to try and take your money on, instead of give you the information that you need to make yourself profitable, they don't work. What works is time in the market. What works is having a plan that keeps you profitable even when the market is sinking away from you. So what I want you to do is I want you to go back and start looking at charts on different time frames. Start looking at, start looking for correlations between levels on different time frames. See how these levels are always correlated across all the different time frames? That's an even stronger signal. They're correlated on the 4-hour charts. They're correlated on the 1-day charts. Anything below 3 hours, I consider noise. You're not really looking at the data in a meaningful way, right? You just got too much noise going on. You've got too much intraday chop. That's not real. That's not how you create these opportunities for yourself. That is not how you make for a 30%er, okay? But you're not going to do this on one market. You're going to do this across a bunch of different markets because it's time in the market. You don't know when the market's going to pop. You don't know when the bull run's going to occur. You don't know when the given market is going to have a correction followed by a return. It's only by having a plan in place and automating that plan, and that's the final part of what we're going to talk about, is how to automate the plan. And that's what I'm asking you to stop trading. Because if you're doing this by hand and actually executing the trades, you're not experienced enough yet to make a plan and make it work for you. You're going to lose money. If you take what I'm saying today and you run out and you start trading in any way, you are not going to understand the value of paper trading. You need to get out a piece of paper. You need to get out your charts. and you need to start making support and resistance levels. And you can use this thing right here to take a snapshot and then copy that snapshot into the Discord. That's what the tatami mat is for. That's what the discussion is for, is so we can help each other learn how to see support and resistance, learn how to make plans that follow good practices, learn good habits about how to make a plan that ensures our profitability. And then plan the trade and trade the plan. And that is the way of the trader. I can't wait to continue the discussion in Discord, and I look forward to our next lesson, which will be on Wednesday. I really appreciate you guys taking the time to learn all of this, and next time what we'll be doing is we'll be talking about more ways to look at these charts and find statistical correlations, and then we'll actually bust open Excel and start making, or Notepad and Excel, and start making actual plans for trading, and figure out how, if they worked on paper, by assuming that in the past we were here, and then making a plan, and then seeing if we can make money with that plan, if we had moved that plan forward over time, and what kind of time frame that would have made us money on, and how much money that would have made us. I look forward to that, and I'll see you guys in Discord.